What's up, everybody? So I asked all of you last night to ask me some questions and then I would answer them, and I may even do a video on them. Well, one of the first questions I got, in fact, I think it was the first question, it was an excellent question, and it was, how do you pay back your investors? He said, let's say I have a friend that wants to give me $10,000. What type of ROI or return should I get him on his money if he lets me borrow it? Well, there's all different types of ways to set this up, but I'm going to tell you exactly how we do it, and then maybe you can model it after that. So let's say investor gives us $100,000. All right, let's say it's $70,000 to purchase the home and $30,000 for the rehab. So it's $100,000 total. Well, they have two options with us. They can either make between 8 and 10% annualized. So we'll pay them 8 to 10% monthly back on how much ever money we have of theirs. And that's for people that want a constant paycheck, that need the cash flow, or just like that better, that guaranteed quote unquote money, or they just want that consistency. They just want to say, look, all I want to do is make 8 to 10%. I don't want to gamble on the net profit. So that's the other way we pay back investors, is they have an option for a 33% profit share. So if we sell the home for $30,000, they'll get, $30,000 net profit. They will get $10,000 of that roughly, and we will get $20,000 as the company. So the better we do on the house and the faster we do on the house, the better the profit share is for our investor. Now, if we hold that house for a year, they probably would have done better if they taken the 8 to 10% interest. Now, I say 8 to 10%, we do work out an exact number, but that really depends on the experience of the investor, how much money they're giving us, how long they've been with us, all types of different things. Look, 8% is fantastic for most people that have had their money sitting in a CD account somewhere making 1.5 to 2%, or even worse, somebody that's had their money sitting in a savings account making 0.5%. So 8% is 8 times what they were making before. So that's why people choose to go with us. And not only that, but you have a deed to the real estate property. You actually have a way that if we default, you get the property. There's no other type of investment, or very few other types of investments, that ever happens. If you give Apple $100,000 tomorrow and buy all their stocks, and their stock completely goes away, completely sinks, goes to zero, you have nothing to show for that. You've just lost all your money. But with real estate, you get the deed of trust if you're the investor, and then you get the house if we default. If we just disappeared or didn't pay your 8 to 10% or whatever would happen, you at least have some type of asset to collect and then go sell it yourself and get your money back. So that's what we do. 8 to 10% on your money. So your buddy would make like $80 to $100, give or take. It's divided by 12 months. Don't have a calculator in front of me, but $80 to $100 a month you would pay him on that $10,000 for as long as you have it, and then prorated once you give it back. So if you give it back on the 15th of the month, you'd only pay half of that. Or you can say, look, just give me your money. I'll go do the entire deal, and whatever we net profit, I'll give you a percent of it. 30% is about market standard. Now, sometimes you're gonna have to pay 50 or more. Look, if this is your first deal and you haven't proven yourself to your investor will be like, hey, here's my money, but I don't know you. You're gonna have to prove it to me, and because I don't know you and you haven't proven yourself, you're a bigger risk to me, so I want 50% of the profit. And that's not unreasonable. Look, getting 50% of a deal is better than getting 0% of a deal every time. So if the only investor you will find in order to do this deal is 50, 60, 70%, I mean, you might have to do it. And that's going to stink at first because you're going to do a majority of the work. But look, the money is just as, if not more, important. It depends on what side you're making this argument. If you have the money, you're going to say it's more important. And if you're bringing all the work, you're going to say that's more important. But really, guys, the money is actually more important. You can find a ton of workers, a ton of people that will put their time into a project, but it's kind of hard these days unless you know who to ask. I don't want to say it's hard. It can be a little bit more footwork to go out there and find that $100,000, that $200,000 for someone to just give you, especially when they don't trust you or know you. So I hope that answers your question. Give them a percent return annualized on their investment, or split the profit with them. Either way is fine. There's other ways to work it as well. Equity in the deal if you're going to rent it, and then you guys split the cash flow, or just agree to split it whenever you sell the property down the line. There's multiple ways to do it, but that's how we do it. So I hope that answers your questions. If you're watching this on YouTube and this helped you, please hit the thumbs up button and subscribe. If you're watching it on Instagram, please go hit the follow button, and I'll try to keep giving you guys more of this information on the regular. Thanks guys for watching.